Wenn wir ins Jahr 2026 eintreten, ist die globale Wirtschaftslandschaft von moderatem Wachstum und sich verändernden Inflationsdruck geprägt. Die Vereinten Nationen prognostizieren eine leichte Verlangsamung des weltweiten Wachstums mit einem erwarteten Wachstum von 2,7% für das Jahr. Dieses Umfeld wird durch Faktoren wie höhere US-Zölle, anhaltende geopolitische Spannungen und anhaltende wirtschaftliche Unsicherheiten geprägt. Die Inflation bleibt ein zentrales Anliegen, das sowohl die Geldpolitik als auch die Anlagestrategien beeinflusst. Die Bewältigung dieser Herausforderungen wird sowohl für Investoren als auch für politische Entscheidungsträger entscheidend sein.
The United Nations projects global economic growth to reach 2.7% in 2026, marking a slight decrease from the previous year's estimate. This moderation is largely attributed to higher tariffs imposed by the United States, which have ripple effects across international trade. Ongoing geopolitical tensions and economic uncertainties also play significant roles in shaping these forecasts, as they can disrupt supply chains and dampen investor confidence. Together, these factors contribute to a more cautious outlook for the global economy in the coming year. Inflation remains a key concern for investors as we move into 2026. The Congressional Budget Office anticipates that the Federal Reserve will begin cutting short-term interest rates this year, with the federal funds rate projected to reach 3.4% by the end of President Trump's current term in 2028. Despite these expected rate cuts, long-term yields, such as the 10-year Treasury, are forecast to rise slightly from 4.1% in late 2025 to 4.3% by 2028. This suggests that borrowing costs, including mortgage rates, may become more expensive even as monetary policy eases. These developments are likely to influence market dynamics, shaping investment strategies and asset valuations in the coming years. As Treasury yields are projected to rise slightly in 2026, reaching 4.3% by the end of the year, investors may face higher borrowing costs and more expensive mortgage rates. This environment could prompt a shift in investment strategies, with some opting to reduce exposure to interest-sensitive assets like bonds and real estate. Rising yields often signal tighter financial conditions, encouraging investors to seek alternative opportunities in equities or inflation-hedged assets, such as gold and Bitcoin. The prospect of increased mortgage rates may also slow housing market activity, influencing portfolio allocations. Understanding these dynamics is crucial for navigating the evolving financial landscape in 2026. Smart money investors are increasingly looking to diversify into emerging markets, recognizing their potential for strong performance in 2026. Several factors are driving this projected outperformance, including lower local interest rates, ongoing corporate governance reforms, and significant infrastructure investments powered by artificial intelligence. Markets such as Korea and Taiwan are particularly attractive, with forecasts of double-digit equity gains fueled by rapid technological innovation. By allocating capital to these regions, investors aim to capture growth opportunities that may outpace those in more developed economies. This strategic shift reflects a broader effort to navigate inflationary pressures and secure long-term returns. During periods of monetary uncertainty and rising inflation, investors often seek out real assets, such as gold and Bitcoin, to protect their wealth. Gold has long been considered a reliable store of value, especially when traditional currencies face debasement. In recent years, Bitcoin has emerged as a digital alternative, attracting attention for its scarcity and resilience against inflationary pressures. Both assets are viewed as effective hedges, offering diversification and stability when markets become volatile. As economic conditions evolve, their roles in investment portfolios continue to grow in importance. Investor sentiment toward U.S. equities remains positive as we enter 2026. The S&P 500 has demonstrated remarkable resilience, achieving 36 all-time highs in 2025 and delivering a 17.5% return through October. Looking ahead, analysts project continued gains, with price increases around 9% and total returns, including dividends, approaching 11% for the year. This sustained momentum reflects ongoing confidence in the market, despite broader economic uncertainties and inflationary pressures. Thanks for watching. Recent market indicators provide valuable insights into investor sentiment as we enter 2026. The S&P 500 is trading at $694.07, reflecting ongoing confidence in U.S. equities and expectations for continued growth. Gold, priced at $414.47, remains a popular hedge against inflation, while Bitcoin's value at $90,575 highlights its role as a digital store of value. Oil prices, with the United States Oil Fund at $70.78, are influenced by global demand and geopolitical factors. Meanwhile, the U.S. aggregate bond ETF at $100.16 suggests cautious optimism in the fixed income market as investors balance risk and return amid evolving economic conditions. In 2026, smart money investors are responding to a shifting economic landscape marked by moderate global growth and persistent inflationary pressures. To adapt, they are reallocating assets toward emerging markets, which are expected to outperform due to lower local interest rates and advancements in technology. Real assets, such as gold and Bitcoin, are also gaining popularity as hedges against inflation and monetary uncertainty. Meanwhile, optimism remains for U.S. equities, with the S&P 500 continuing to deliver strong returns. By diversifying across regions and asset classes, these investors are positioning themselves to navigate the evolving financial environment. Thanks for watching. Thank you for joining us as we explored where smart money is moving during inflation in 2026. We hope this overview of market trends and investment strategies has provided valuable insights into the evolving economic landscape. Stay informed and prepared as global conditions continue to shift. Thanks for watching.